So you're on your phone, you see a stock you like, and you tap buy. Seems so simple, right? Just one click. But in this explainer, we're going to pull back the curtain on the incredible, super fast world that your single tap unleashes. The moment you hit that button, your order is officially on a journey. And it's a wild one. It's a high-speed trip through a huge financial ecosystem, and its only goal is to find a matching seller. We're going to follow it every step of the way to see exactly how that simple click becomes a done deal. That one little tap, it sets off a massive chain reaction. It basically wakes up an entire financial ecosystem. So let's meet the key players who get involved. Okay, first things first, for your buy order to actually work, it has to find a sell order. I mean, that's obvious, right? This brings us to the two fundamental sides of any financial market. Think of it like this. The buy side, well, they have the money, and they're looking for places to put it to work. The sell side, on the other hand, is in the business of creating and selling those investment opportunities, things like stocks and bonds. They're basically two sides of the same coin. You absolutely cannot have one without the other. Now, the buy side isn't just one kind of investor. It's actually anyone with money to invest. So that means when you place a trade from your living room, you are technically on the exact same side of the market as some of the biggest financial institutions on the planet. We're talking giant pension funds and massive hedge funds. And the sell side? Well, you can think of them as the market's architects. These are the investment banks and advisory firms that work with companies to create the very securities the buy side is looking to buy. They're the ones helping businesses raise the money they need to grow, to innovate, and to build new things. Okay, so your order represents the buy side. We've got that. Now it needs to go somewhere, an arena, if you will, to find a seller. And it turns out this somewhere can be a couple of very different kinds of places. Your trade basically has two main types of destinations. You've got your lit exchanges, which are totally public, where every single order is out there for everyone to see. And then you have dark pools. These are private trading venues that now handle a pretty staggering amount, over 40% of all stock trades in the US. Lit exchanges, like the New York Stock Exchange, are what most of us picture when we think of the stock market. And their transparency is absolutely crucial. Why? Because it allows the forces of supply and demand to set a fair public price for a stock. Everything's out in the open, all the bids, all the offers. But imagine you're a huge institution and you need to sell, say, 1 million shares of a stock. That public visibility suddenly becomes a massive problem. If the whole market saw that giant sell order pop up, the price would probably tank before you could even finish the trade. Dark pools let them find a buyer for that huge block anonymously, without tipping their hand to the rest of the market. Now, whether your order lands in a lit exchange or a dark pool, it still needs to find its other half. And that's where it meets one of the most important, but maybe least understood, players in this whole process, the market maker. The market maker's entire job is to always be there, constantly offering to both buy and sell a particular stock. This provides what's called liquidity. It's the grease in the wheels of the market, ensuring that when you want to buy, there's always a seller ready, and when you want to sell, there's always a buyer waiting. So how do they make any money doing this? They earn the spread. It's simple, really. They might offer to buy a stock for $50.47, that's the bid, and at the exact same time offer to sell it for $50.48, that's the ask. That tiny 1 cent difference is their profit. Now, that doesn't sound like much, but multiply that penny by millions and millions of trades every single day. A simple order book like this one really shows the market maker's role in action. You can see the orders to buy, the bids, at slightly lower prices, and the orders to sell, the asks, at slightly higher prices. By always providing both, they create that tight spread that allows your trade to happen almost instantly. So, your order has found a match. A seller has agreed to your price, and the trade is executed. But believe it or not, we're still not done. The deal isn't official yet. There's a final handshake that has to happen behind the scenes. This is what's called the post-trade life cycle. First, your trade is executed. We call that day T for trade day. Then, almost immediately, it goes into a process called clearing. And then on the very next business day, or T+1, the trade officially settles. Settlement is the final step where the shares are formally moved to your account and the cash is sent to the seller. The clearinghouse is really the unsung hero of this whole story. It steps right into the middle of the trade, and it acts as the buyer to the seller and the seller to the buyer. This guarantees that even if one side were to back out for some crazy reason, the trade will still go through. It's a critical safeguard for the entire financial system. Whew! We've just traced the journey of a single click through this whirlwind of systems and players. But what's the big picture? What is the grand purpose of this incredibly complex, high-speed machine? Well, this entire ecosystem really does three essential things for our economy. First, all this constant trading helps discover fair prices for assets. Second, it provides liquidity, which is just a fancy way of saying you can buy or sell whenever you want. And maybe most importantly, it's the engine of capital formation. It allows companies to raise money from investors like you and me to go out and innovate, grow, and create jobs. So the next time you click buy, you'll know the incredible journey your order takes. But this whole journey leaves us with a pretty fascinating question, doesn't it? We know that over 40% of trades are now happening in the shadows of dark pools. So in a world like that, who ensures the price you see on your screen is always the fairest one?